Welcome, everyone. This is Quinn Arnold, and with me today is Matt Hilland, one of our planners at the firm and a partner. And you are joining us for a webinar on life and disability insurance. Matt will be doing most of the presentation today. I will stay in the background. I'll be watching the chat box. If you have any questions and would like to pose them there, feel free. We also are keeping the lines open afterwards for questions if you have a question that you want to ask and you're comfortable having that in front of the group. If not, we can follow up with a phone call or a scheduled meeting for after this. All right. Well, thank you again for joining. We are excited to keep doing these. We're doing a number of different types of financial planning and investment topics. I think for next week, we will be planning to talk about charitable giving and how to maximize your charitable impact with the investments and savings that you have. So for this week, though, I'm going to turn it over to Matt to talk to you about life and disability insurance. All right, Matt, go ahead.
All right, thank you, and thanks for joining us again today. As Quinn said, today's topic is a very important one. Many clients we work with are set up to have very successful plans if they can simply just keep doing what they're doing with spending, saving, working or earning income. But we know life always doesn't go to plan. We're seeing that in the headlines today, but that risk is always going to be out there. And one primary way to protect against these unforeseen events is through insurance. The problem is, though, if you go to an insurance agent, their commission is based on how much insurance they can get you to buy and what type of insurance they get you to buy. We believe that's a big conflict of interest since they profit from convincing you to buy more insurance. So we're doing this webinar today because we thought we could provide a unique opinion on insurance, as unlike most people who are out there today talking about insurance or selling insurance, we don't collect any commissions from any insurance products. And so let's get started. We can spend all day talking about the various types of insurance, but today we decided just to look at two main types, and that's disability and life. The first topic we're going to go through is disability. As with any insurance policy, there can be a lot of fine print, but most generally, disability insurance is there to pay a portion of your income to you should you have an illness or accident that prevents you from working. Usually, you're looking at 60% of your income for standard disability policies that are out there. Disability insurance can be both short-term or long-term, depending on the interruption to your income that could prevent you from working. Generally, short-term means up to 90 days, where long-term can be set up to pay for years or even your entire life. When you think insurance, the first thing that jumps to your head is probably life insurance. And while life insurance is very important, at the sign up of this webinar, we had a note about how disability insurance might be more important than life insurance for many working professionals today. And that is true for a couple of reasons. First, for younger people in particular, becoming disabled sometime in your life is much more common than dying. Someone aged 30 today has a 1 in 3 chance of being out of work, or at least limited in their work, for at least 90 days sometime in their life. An important note on this table that's shown here is that this is the likelihood of your income being impacted by a disability event. It goes without saying that those that are age 60 or older probably are more likely to have a condition, but if they're retired, there's no impact to their income, so they won't show up on this chart here. So you'll see a lower likelihood for this table for those age 60 because many of them are retiring within a few years, and so there's less time for a disability to incur while they're working. Just to give you an idea on the type of events we're talking about for qualifying for disability insurance claims, the most common for long-term disability are cancer, mental health, heart disease, and then your broad types of injuries, arthritis or a pulled back or a broken ankle, things like that, that would prevent you from doing your normal job duties. And so that's what we're trying to insure against with these types of policies. And lastly, we find disability insurance to be more important for many because while a lot of people think of death as a worst case scenario, and that is certainly true on an emotionally and for a number of other reasons. It's not necessarily so from strictly a financial perspective. It's easy to imagine that a severe medical event could occur that results in not only a loss of income, but also substantial increase in costs and medical bills as well. And as with life insurance, if you work for a large employer who has a group disability policy, it might be worth seeing what you have there and whether or not you can buy up any additional coverage through your employer. Even if you know you have a disability policy through your employer, it's important to review the details because benefit amounts can be capped, the terms could be shorter than you want, so your benefit could be much less than you were expecting or what you think you'll need. So step one is always to check with your employer to read about the details of their current policy. But besides your employer, a lot of people think they're covered by workman's comp or Social Security disability, but that's not always the case either. Less than 5% of accidents happen at the workplace, so workman's comp is not always going to be there for you if you need it. And average Social Security disability is about $1,260 a month, which is probably significantly below what most households need to make up for the lost income of the spouse, and could very easily not cover any added care or medical costs. If you've had high income, yours could be a little bit higher than that $1,260 a month, but it's not going to be anywhere near your current salary or the income that you're used to. And Social Security disability is only for long-term disability. You must be disabled for 6 months before you can even begin to collect. So for a lot of people, there exists a need outside of Social Security or workplace protections to insure against this need. And when you look at a policy, there's a few things to consider. Benefit payment is simply how much you will be paid. You want to make sure that if you have a need for this insurance, it's actually going to do its job and pay for what you need it to. Some policies also have residual benefits where they'll make up for lost wages. So if you're only able to work part-time or for a much lower salary, it'll make up the difference in that lost salary. The length of benefits also very important. This is the length that an insurance company is going to pay for you if you become disabled. For short-term policies, it's usually no longer than 90 days. For long-term policies, it could be your whole life, or is generally until you reach age 65. Elimination period is the amount of time the insured must be disabled before benefits begin. The longer the elimination period, the lower the premium, but it means you're on the hook for paying for possibly several months of expenses. Most long-term policies have a 90-day elimination period, but you can get much longer as well. And then COLA is another added benefit to some of these. You want to make sure that the amount that you're getting from your insurance policy increases with inflation over time. So if you need $50,000 a year to make up for your living expenses, 30 years from now, $50,000 might not pay for as much as it does today. So you want to make sure there's a cost of living adjustment in there too. And lastly, and maybe most important, is depending on your occupation, what exactly the disability insurance covers. The classic example here is a surgeon who's very in a very specialized field with very high income. And if something were to happen that maybe just impacts the dexterity of his hands, he might be able to do a lot of other jobs still, but not surgery. And if he's able to earn an income at another job, even though it would be much lower pay, some policies might not pay out because the surgeon would still be able to earn an income. So the surgeon would want to make sure he has the right policies to protect him and pay for that high salary that he's used to. And throughout the webinar, we're going to show a lot of estimated costs for these different types of insurance. But it's important to note that these are just assumptions meant to give you, a ballpark estimate for costs. The rule of thumb for long-term disability insurance is that it costs between 1% and 3% of your salary per year. So if you make $100,000 per year, a typical disability policy will pay you $60,000 per year. and that will cost you between $1,000 and $3,000 a year, depending on your occupation and some of the benefits that we discussed on the previous slide. So these costs are not inconsequential, but I think most of us could live with a 1% salary reduction, and that reduction could really help prevent some potentially catastrophic scenario like a long-term disability from impacting your finances. Okay, that was a brief summary on disability insurance. Now on to life, which many of you are probably more familiar with. The concept of life insurance is simple. Your beneficiaries get paid if you were to pass away. And obviously this is incredibly important for households who depend on a spouse's income to pay their bills. We could spend a week talking about all the ins and outs of different types of life insurance, but here we're going to look at 3 types that make up the majority of insurance policies out there today: term, whole life, and universal life. I talked before about how we feel we have a unique voice in the life insurance discussion because we're not selling policies. And if you look at that chart to the right, which breaks up the insurance sales from, this was 2018, you'll maybe start to see why. For the vast majority of our clients, I want to say all, but I'll avoid the absolute, we find term insurance to be the right fit for them. But you can see term only makes up about 20% of total insurance premiums written. That's a huge gap that just starts to show you the impact of being a good salesman in the insurance industry. And we're going to group whole life and universal life in the second part of this webinar, as they're both what's known as permanent insurance, meaning they cover you for as long as you pay the policy. Whereas term insurance is only designed to pay for a specific period, say 20 years. And so starting with term, I wanted a way to make this slide exciting, but it's hard. And that's because term insurance is very simple. You choose a time period you want to be insured, say 30 years. You choose the benefit that you want to be paid if you would die in that period, say $500,000. Then the insurance company is going to give you a premium. And unlike other types of insurance that we'll talk about later, that premium stays constant for the rest of the policy. So if you buy a 30-year term policy that costs $30 a month, it's going to cost $30 a month today. And in 29 years, it's still going to cost $30 a month. The primary benefit of this simplicity in term insurance is its costs. Relative to other types of insurance, term is cheap. We'll look at this exact same chart for other types of insurance that we'll go through, and we'll summarize it at the end too. But shown here is just an example for the cost of $100,000 in insurance coverage for a 30-year term based on your age. And so for a younger person looking to insure against a very catastrophic event, for the price of a Netflix subscription, you can have a little peace of mind. And because term insurance is easier to understand, it's also relatively easy to calculate your insurance needs for a lot of scenarios. Generally, you're looking to match up future liabilities with an insured amount. For example, a young couple with a child may want to make sure that there will be funding available for college, even if something were to happen to one of the spouses. So they might take out a 20-year policy that will be there while the child is in college age or younger, and with a benefit that would be enough to pay for the expected college costs. Mortgage are another big liability. If you just bought a big house with a $300,000 mortgage, you might want to add a term policy that's active while that mortgage is outstanding. But of course, the biggest thing we're protecting against here is the loss in income. If you're age 30 and make $50,000 a year and you expect modest career advancement and wage growth over time, we're talking millions of dollars in lost wages if you were to pass. And calculating this, and more specifically the insurance need to replace this, takes a little bit more planning because it depends on your spouse's income, your goals, your expectations, and a host of other inputs. This is where some planning's needed. For those of you who have done this with us, it takes place over a meeting or two, and we can sit down and show you some reports and scenarios to help find the right amount for you. We think one of the reasons that term life is superior to what else we'll be looking at is because people have a need for insurance earlier in their lives, but usually not later in their life. Again, it's tragic, but the financial hardship you leave your family if you pass at age 90 is probably very different than if you passed at age 35. And that's where term fits in very nicely. For a very reasonable price, you can insure during your time of greatest need and then stop paying later in life when the coverage is not needed. And term policies also have the ability to be stacked or laddered, which we're trying to show here, where your insurance can drop over time. We tried to show here a hypothetical young couple who has 3 different term policies of differing lengths to try to match their projected insurance need over time. And so at age 30, you might have a young child and a mortgage, and so your insurance needs going to be greater. But you don't need that same insurance amount at age 60 as you do at age 30. So you can buy a large, shorter term policy that's only good for, just for example, 10 years, and then stack that with other longer term policies to match your smaller insurance need later in life. And as we'll see, this strategy has huge savings compared to buying, a $400,000 whole life or universal life policy, just for example. And now moving into that, switching gears to permanent insurance. This is the whole life and universal life policies that make up about 70% of insurance policies that are written today. Their benefit, and if you could see me in person here, I'm making air quotes as I don't necessarily believe it, but if you talk to an insurance agent, the benefit here is that the insurance you buy will be there for the rest of your life. If you buy a 20-year term policy and die after year 21, you don't get anything. Whereas with permanent insurance, as long as you keep paying the premium, you will get a death benefit. We don't think this is especially useful for most people since, as we said, you typically don't have a big insurance need later in your life, but there are scenarios where this makes sense. The classic example is for parents with a special needs child. They want to ensure that, no matter what, there'll always be money left over at the end of the plan to pay for the child's projected future expenses. Another case could possibly be for those who want to be sure to leave a specific amount or a significant amount to charity. You could buy a $100,000 permanent life policy to ensure that maybe your alma mater or your favorite charitable organization gets something at the end of your life. First, we're going to look at universal life. These types of insurance policies get very complex. There's many different types of universal insurance. The big difference is the guaranteed universal, which has fixed rates, so like whole life and like term, while many of the other types can see increasing premiums as you age. And this is a huge drawback for non-guaranteed universal life policies. We've seen some nightmare stories of policies that have thousands of dollars per month in premium to keep active. And the policies end up being the least affordable after you've been paying into them for decades and might just be a few years away from realizing the benefit of them. But the main points for universal life is that as long as you pay, you're covered. Universal policies do have some cash value, which is like a savings account that's tacked onto the side of these policies that can be used to pay premiums or take out loans against. But their cash value component is typically much smaller than whole life, which we'll look at next. And because of this, premiums are generally lower than whole life. But again, you need to be sure you know what you're buying because they may be cheaper now, but they will not be in the future. And there's a lot of different fine print that can be in these policies. But like many other things, with all this complexity comes extra costs. Universal life is significantly more expensive than term. We're looking at roughly 5 times the premium for a younger person for the same amount of coverage and at least double for someone older, maybe in their 50s. Next on to whole life. Like universal life, whole life is also a permanent type of life insurance. As long as you pay the premiums, you'll have coverage. Where whole life differs from universal is that the cash value becomes a much larger part of the policy. You'll see on the next slide that whole life is even more expensive than universal life. And that's because you're also building up this larger cash savings or cash value account over time. This larger cash value can help pay the policy's premiums over time. They usually refer to this as a policy being, paid up, where you can stop writing checks to the insurance company for the policy because this cash value that's on the side can be used to pay the premiums instead. But in general, whole life provides more guarantees than universal life. Premiums are steady, you get a guaranteed benefit amount, and you get a guaranteed growth rate on your cash savings, but note that it's still low. Look, there's a recent Consumers Report study that found the average guaranteed growth rate of the cash portion of a whole life policy to be 1.5%, and 3.5% is the average projected growth. So they don't guarantee 3.5, but if you're in there, they'll tell you, you'll probably get 3.5. And this is from, a couple of years ago, so this could be even lower now with interest rates having dropped more. But just to give you a rough idea. And whole life policies are typically touted as a way to get insurance and save because of the cash value that grows over time. But you can see from here, you're getting a pretty low return on that cash. So we like to say whole life is an expensive way to save money. We'll look at specifics of this on the next couple of slides. Here's just how expensive that whole life policy can be. We're looking at 5 to 10 times as expensive as term and about double universal life. Even a young client that's 30 years old would be paying, a significant amount of money for a $100,000 death benefit. And just to summarize, here's the 3 types of insurance we talked about with their costs for $100,000 policies side by side. Again, there's a lot of assumptions that go into here. This is a very general, just to give you a ballpark range of what we're looking at. But this is the primary difference between these policies. And so we find for a vast majority of people that buying a term policy and investing that difference would likely be, the optimal course of action. Most people do not need big insurance policies later in their life. Term insurance does what it's made to do. It provides insurance for when you need it, and it frees up cash flow for you to save in better vehicles like a Roth IRA, your 401k, or even a taxable brokerage account, which over time you would expect these investments to outperform the cash balances in a life insurance policy. And a lot of companies sell insurance policies. There's nothing wrong with going to a Northwestern Mutual or a State Farm for a simple term policy. Just be aware that they will probably be making a pretty heavy pitch for other types of insurance as well, because the commissions and the cost to you on those policies are much greater. So if you don't want to put up with that, here are 2 companies that we recommend talking to. Ladder is a relatively new player in the space, but we've been impressed with what we've seen so far, and they only do term insurance policies. The other company we direct clients to often is LLIS, or Low Load Insurance. They do a wide variety of insurance, term and permanent life insurance, along with disability and even long-term care. We also like working with LLIS because they focus a lot on education. They're real good in their emails about making sure you understand all the specifics of your policy. They'll help you compare current policies with what else is out there, help you with any exchanging. They're just really good at taking the time to walk through things with you, which is really nice. And this is our last slide, but I just wanted to end with a way to kind of bring everything we talked about full circle. No one likes the idea of paying extra monthly expenses. Things like disability insurance and life insurance are not necessarily cheap, no matter which option you choose. But we know for many of you, you have very successful financial plans. If everything goes according to plan, you'll be very well suited in retirement. And if you're in that position, it's a great time to step back and look at potential risks, because for many clients, the additional costs of these insurance policies do not significantly impact their long-term plan, but a catastrophic scenario such as early death or disability certainly would. And so I think, the best case scenario is that you would buy these insurance policies and never use them. I think we can all agree that that's the best outcome, regardless of the cost. But for that unlikely occurrence, money spent on these policies is very well worth it and can certainly save your household a lot of financial trouble. So that's all we had for today. Thanks again for joining, and have a great weekend.
All right. With that, I want to open it up for questions. Thank you, Matt, for taking us through the different types of life insurance and disability insurance. A lot of people don't know much about disability, so I think that's important. Any questions from the broader group?